The RBA kept the benchmark cash rate at 3% for the second month in a row, but said that further reductions may be required. Today I'm joined down the line by Alan Collins, analyst at 3C Analyst, to discuss Australia's response to the low rate setting and what he expects from the Aussie dollar. Alan, thank you for once again sharing your insights with Dukes Copy TV. Firstly, in your opinion, is there still scope to cut interest rates further?
Well, I think I'd have to concur with what the RBA board members did say in their minutes, and that was that there is scope for further cuts, and in fact, they believe that it might be essential to keep the economy going. We're looking at maybe one, possibly two cuts during the course of the year, but that would depend on how the world economy was progressing, as well as the Australian one, obviously.
With all eyes on Cyprus and Europe this week, are people looking to Australia as a safe haven and an attractive investment compared to Europe?
Well, I do think that Australia is always regarded as a safe haven whenever there's issues in Europe, whatever they may be. It's almost a geographical thing. The further away you can get geographically, the better. Although whether that works in today's environment is another issue. I do tend to think that the Cyprus did provide an enormous shock for all the financial markets yesterday. In the greater scheme of things, it's small compared with the euro crisis that we saw last year. And we're already seeing the impact dilute across the board. And I do think the ripples from it will continue to get smaller. Nonetheless, from a technical perspective, there are reasons to believe that the Aussie will continue to show progress on the upside.
What did we see from the Aussie dollar after the release of the minutes?
Well, we did see that the Aussie gave back some of the gains that it made Monday after the announcement, but I'm not so sure that related to the RBA announcement, but was more unwinding of some of the panic moves made after the Cyprus bailout and all the press coverage of it. From a technical perspective, we are looking for a slightly weaker Aussie as a corrective move during the course of today, possibly extending into tomorrow. But around the 103.20, 35 area, we're looking for buyers to come back in. But on the longer term, there is a classic inverted head and shoulders pattern, which we think is very important. It does have interim resistance at 103.75, 104.15, but this pattern is generally an excellent indicator of a fairly decent move in almost any asset class. We're looking at a measured target here of 104.55 minimum, and then probably onto 105.75. But it is probable that the Aussie strength will find levels above 106 really difficult to maintain. There's a broad range that stretches all the way back to last July, which is capped at 106, and we think that the RBA and the Australian government will try and keep that lid on it.
Finally, Mr. Collins, after the economy expanded more strongly than expected in the final quarter of last year, what do you see for growth now from Australia? Is it on trend this year?
Yes, I think it is. I think the RBA did mention that things were progressing and that they were making progress with the interest rates cuts that had already been made. But like the world economy as a whole, and virtually every country you look at, any recovery at the moment is very fragile. So I think that goes back to their mention of cutting rates again, just to keep momentum going if things start to falter. And that's why, again, I think that 106 will be a level that the RBA will look at and think that they don't want the Australian dollar to appreciate beyond that, because that will be working against the growth potential. Don't really want to talk about currency wars and competitive devaluations, but I certainly don't think the RBA will want to see too strong an Aussie.
That was Alan Collins from 3C Analysis with his predictions for the Aussie dollar. I'll be back tomorrow with investor insight into 3 currency pairs. I'll see you then.